Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, and my guest is Christian Munafo, Chief Investment Officer and Portfolio Manager at Liberty Street Advisors, Inc. Welcome, Christian.
Hi, James.
It's a pleasure to have you on, Christian, and to get into the nitty-gritty of late-stage venture capital. So could I ask you from the outset, to take us through what's described by that term, late-stage venture capital, in terms of a company life cycle?
Sure thing. So the easiest way to think about late stage venture is at a point in time where a company has already established its business model. It has an identity, it has products and services, it has customers, it has revenue, it has real operating metrics one can kind of dig their teeth into and analyze. So we're not going at the early stage where it's more of a conceptual opportunity. Early stage investing is just fine, but it just comes with a different risk profile and a longer duration. Coming in later stage in companies that are generating 50 million, hundreds of millions, some cases billions in revenue, allows for one, the ability to do more diligence to get a better understanding of what the true opportunity set is, as well as the future trajectory. And it also allows for, in our experience, a shorter duration in terms of when that underlying company can achieve a liquidity event, whether that liquidity event be a public offering of sorts or a trade sale.
So does that imply that you're not going to get the home run style returns that a VC early stage investor might get, but also you don't have the strikeouts that they have, to continue that baseball analogy?
That is very accurate. Although we would say that there are situations where we have been able to generate very significant returns, sometimes in excess of 10 times on an individual company basis. But typically late stage investors are looking to do anywhere from 2 to 5 times on a money multiple basis. And if you blend that across the average holding period of these companies, it averages somewhere in the 15 to 20% range for an overall portfolio of a late stage asset class.
So what are the truly unique characteristics of late stage venture capital?
Yeah, so for us, one of the key things is that, again, you have a company that has already refined its concept into an actually functioning business. And so you have real line items that you can monitor in terms of what their revenue looks like. What is the cost of these companies to acquire new customers? What are the long-term value metrics of any given customer? So how does it perform over time? Are companies continuing to buy more for the company, or do they churn out quickly? So we're looking for companies that have a certain level of revenue maturity, so we can see if there's predictability in the model. We can see if there is a tendency for this company through pattern recognition to continue hitting its growth rates, right, and its expectations, so we can grow into a much larger, more valuable business. And so these companies also typically have a very well-established management teams. They have a very well-established syndicate of investors and board members that can really help steward these businesses through all different types of cycles. So that's kind of what we look for in these later stage companies. And for our clients, we're trying to find an access point in them to get exposure for our clients.
Christian, from the point of view of the end investor, and particularly the retail investor, what's the most appropriate investment time frame, time horizon they should be prepared to give a late stage venture capital investment?
Yeah, so the way we assess it is, when we make an investment in a later stage company, we typically have a 2 to 4 year anticipated holding period before we expect a organic liquidity event. We can also sell our positions into the private market, so we don't necessarily have to wait for a public event or an M&A type trade sale. And the reason we have that 2 to 4 year hold period is because we want to see that there's value appreciation as these companies continue to grow after we invest. So we kind of recommend a similar holding period for investors to have in mind, because if we're not able to harness the underlying value appreciation on a deal by deal basis for them, then the client's not going to be able to benefit in parallel with that creation. So we expect the client should come into this with a multi-view, multi-year type perspective to benefit from it.
And within the portfolio of that end investor, Christian, what's the prime role of late stage venture capital in your view? Is it to act as a diversifier or a return source?
I think both. When we kind of step back and talk to clients about how they've historically used our product and how they plan to use the product on a go-forward basis, there's really three categories. One is as part of their alternative investment strategy, where they look for alpha generation in, often areas that they can't find in the public markets. And so we, as a kind of late stage venture, private equity oriented strategy, fall under the alternative category. So we're one segment in that strategy. Other reasons groups use us is because when they look at the average market caps of the companies that we typically invest in, they tend to be in the single to mid-digit $billion. And that's essentially becoming a proxy for what a lot of groups used to view as a small mid-cap type public strategy. So we become, for some groups, a proxy to what they can get in the market for a small mid-cap strategy. And then some groups, quite frankly, use us for the fact that we're non-correlated to most of the public types of strategy they invest in. So I think it's a combination of diversification, alpha generation, and non-correlation.
Should late-stage venture capital always be viewed as an illiquid investment in which the manager harvests an illiquidity premium, or do you really have to offer some form of liquidity given that not everyone can lock up money?
Yeah, so it depends on the structure of the vehicle you're investing out of. And so the structures of the vehicles that we're investing out of, we've intentionally created the ability for there to be partial liquidity on a quarterly basis. So a small percentage, typically up to 5% of the funds that we manage, will have the ability to generate liquidity for those clients who have a desire or need for it. But this, again, getting back to the question you had earlier, this is a longer term strategy. And for investors to be able to truly benefit from the type of the strategy we're executing, they need to have a multi-year horizon, because these are, at the end of the day, liquid investments until they're not.
Christian, it seems that many more companies are choosing to remain private and also doing so for longer periods. What do you think explains this decreasing willingness to actually go public?
Yeah, I mean, it's a main reason why groups like us, frankly, exist, James. And so when we kind of step back and really try to deconstruct what's led to this trend over the last couple of decades, where your number of publicly traded companies has really been cut almost in half. If you look at just the US alone, while the number of private companies has surged, we think one of the reasons is regulatory driven and administratively driven. It's very expensive and burdensome for companies to get IPO ready. On one hand, I think the next part of it is that a lot of these companies that are focusing on optimizing their growth, and they're growing at 50, 100, 200% growth, they may not have actually figured everything out yet about how to optimize every aspect of their business model. And when they're now being held as a public company accountable to hit their quarterly earnings, it can expose them to unnecessary volatility. So we think a lot of companies have also elected just to push off that IPO volatility exposure until they're really ready and properly positioned to address it. And then lastly, and perhaps even most importantly, there's just been such a large addressable surge of capital that's been made available to these private companies where they have not had to tap the public markets. And so think back to the 90s, where your average, tech-oriented company would look to go public in several years from its inception because there wasn't really private capital available to continue to finance them. And they would go public at an average of, call it, $500 million market cap. And most of their value appreciation would happen then as a public company. Now we have a dynamic where these companies are staying private 12 years, some cases 15, 20 years, and they're growing into much larger companies in the private market while that private capital is available. And what's critical about that is a lot of their capital appreciation and market cap growth is happening in the private market. So by the time that a public market investor has an opportunity, if any opportunity, to access them for the ones that go public, they've arguably lost out already on a significant amount of growth. But those are the main reasons why we think companies have elected to stay private longer.
Thank you, Christian. This has been INDepth, and my guest has been Christian Munafo of Liberty Street Advisors. Thanks very much for your time, Christian.
Always a pleasure. Thank you, James.